Welcome, and thank you for joining Oil and Gas 360. We're here at EnerCom's London Oil and Gas Conference with Robert Turnham, Chief Operating Officer and President of Goodrich Petroleum. Thanks for joining us, Rob.
Thanks, Brian.
So it's no secret that the oil and liquids-rich plays have sort of dominated the E&P landscape. Talk to us about your initiatives in the Eagle Ford and sort of what separates you from the other companies operating in the play.
Yeah, Brian, it was easy. About a year and a half ago, we had two options on strategy. One was wait for gas prices to turn, or two, go find some oil. And the first option wasn't a very good one. We started looking at areas that were predominantly oil production. We always have been an early mover, and we identified the Eagle Ford oil window as an opportunity to jump in ahead of the market, get in at a low price. We got in at about $16.50 an acre, and we sit right next to where Chesapeake did their joint venture at over $10,000 an acre. So again, an early mover like we had been in the Haynesville and the Cotton Valley before that. We're in an area that's 80–85% oil. We're in an area that we have 40,000 net acres, a lot of running room, and the ability to kind of manufacture the oil. In fact, you're going to see that change in our mix. We'll go from 2% oil in 2010 to 15% oil in 2011, and we'll exit with north of 20% oil. So it's an area that works very well. We're surrounded by other operators, and real excited to have that lever to flip for the first time in the company's real history to go oil versus gas.
So the oil and liquids goals that you have set, what operational objectives are included in your CapEx to sort of meet those goals?
Yeah, we've really high-graded the 40,000 net acres. We think it's all perspective. The further south you go, the deeper the acreage is, the easier it is to lift the oil, the higher the production rates, and likely higher EURs. So we've really kind of focused in the southern 60% of our acreage block this year. We're getting economies of scale by drilling off of pads. We have some pad drilling going on. We have much more consistent results down there. And so that alone is going to allow us to get the traction that we want to see. We'll come back in the northern 40% and develop that once the traction occurs. But we think it's all good. The northern portion probably needs to go on artificial lift sooner. But yet we still have high hopes for that acreage. But the southern portion will allow us to get the traction that we want.
And you mentioned your low-cost entrance, about $16.50 an acre. We're now seeing acreage deals being inked at nearly $20,000 an acre. So, sort of are the acreage costs something that the industry needs to get used to, or B, what's sort of your expansion strategy in accumulating additional acreage in the competitive environment?
Well, the plays are working. We've de-risked the play, which means the price per acre should go up. They're very economic. We're generating 75% rates of return at $90 oil. That's creating a lot of value, and it's why someone's willing to pay up on a per acre basis. For us, it's difficult to add acreage, knowing that we got in at $16.50 an acre. It's kind of hard to pay up to add acreage there. Again, we've never been very successful at data room purchases and paying up to get something. Our forte has always been identify the acreage, move in early, pay a low price, put our geologic team to work, de-risk it, and create the value. And so I don't really see us, except perhaps a little acreage here and there, primarily designed so that we can drill our way into their acreage versus writing a check. But we think we're probably, for the vast majority of our acreage, we're there already at 40,000 net acres.
So I wanted to touch on East Texas. So tell us about your Cotton Valley trend assets and sort of how the horizontal portion of that play fits into your overall strategy as well.
Yeah, Brian, as you know, Cotton Valley historically has been gas dominated. We have a couple of areas, about 50,000 net acres in East Texas. I would say about 42,000 of those acres is 90–95% gas, and it's held by production, and we'll come back and get it at a later date. We've been drilling Cotton Valley Taylor sand horizontal wells, which is the deepest member of the Cotton Valley. Down in South Henderson, where we have 8,100 net acres, we, from drilling vertical wells, knew that we would see 25 to 40 barrels of oil per million cubic feet of gas by virtue of all the vertical wells that we had drilled in the area. So we went down, tested horizontal development in that field, and really knocked the ball out of the park. We've had 2 wells that we've put online that are producing. The initial production rates were 9 to almost 10 million a day of gas, but most importantly 360 to 380 barrels of oil per day on top of that. So from an economic standpoint, rate of return standpoint, that's the best thing that we have. In fact, it's got a higher rate of return than even the Eagle Ford. But that acreage is held by production. We have 47 locations to drill in the future, and we're going to try to accelerate that likely in 2012. But clearly extremely excited about that play, and the risk profile has already been de-risked because of our vertical development.
Accelerating in 2012, is that when you maybe see an uptick in gas prices, or is that sort of, what's your outlook on long-term gas price?
Well, we're constructive long term. The key is how do you manage the short term, and we're kind of in the camp that it's range bound $4 to $7 gas. We like what we see on the demand side. We're capturing market share from coal. You see a lot of coal plants needing to either be mothballed or refurbished beginning in 2013, 2014. So we think the future is bright for gas. We don't think you're going to see the $12 an M market, but certainly higher prices than what we see right now. So our strategy right now is simple. Focus on oil, grow cash flow by 50 to 100% because of the traction that we're seeing, yet maintain that option value on gas. And most of our acreage is either held by production or subject to continuous drilling provisions that allows you to perpetuate those leases. If you look at sell-side firms and look at research coverage, we and a couple of other firms have the most leverage on a per-share basis to gas price movement. In fact, one sell-side firm had, for every dollar movement in gas prices, our NAV changes by $14, $15 a share. So it's huge leverage. It'll be here. It'll come again at some point in time. But in the meantime, it's all about the oil and all about cash flow growth.
And last question is, I did want to touch on cost as well. Your company continues to decrease its operational expenses and really considered a low-cost peer amongst the group. So your LOE, I believe, decreased 22% on a per unit basis to about 54 cents per M during Q1. How are you implementing these low-cost lessons, learned for your Eagle Ford development?
Yeah, the Eagle Ford's a little more challenging in that it's an oil play, and oil plays typically have a little bit higher lease operating expense. We've actually cut in half our LOE if you go back a couple of years from previous days. A lot of that is our efforts and expertise. A lot of it's Haynesville volumes come in at extremely low LOE per unit. Our costs there are 15 cents per MCFE, wow. So it's just off the charts low. We're expecting the Eagle Ford to come in roughly $1.25 per MCFE. So far it's been a lot less than that, but we think over time, as you put these wells on pump, your LOE will gradually grow. But it's not really about cost, it's about margins, and these oil plays have tremendous margins, and you'll see that expansion of our cash margins as the oil becomes a bigger and bigger piece of our production profile. Like I said, we're going from 2% to 15% oil in 1 year. We'll be north of 20% as we enter 2012, and it's going to continue to grow from there. So again, flexibility of capital expenditures. We've never had this much flexibility to be able to flip a switch and go either oil or gas. And certainly oil cash flow growth from oil volumes is going to drive short-term stock price performance. Long-term, we get that incremental juicing from gas prices moving.
Well, I really appreciate your time, and thank you for joining us again,
Thank you,
Rob.
Brian.